19 of 19 series are aligned with stagflation mild this morning. That is full confirmation in the framework across all 19 series. The current macro regime is stagflation mild, with a confirmation score of 19 out of 19. The macro regime label stagflation. Mild describes a configuration where growth momentum is decelerating at -0.6082, while inflation momentum is accelerating at +0.0081. In practical terms, the engine is observing softening economic activity alongside persistent price pressure. The coherence score 19 out of 19 and the confirmation score 19 out of 19 indicate that every series in the regime panel is mathematically consistent with that description this morning. Historically, regimes with a confirmation score in this range have persisted in 52% of comparable cases over 3-month windows. Compared to last week, confirmation has stepped up from already elevated readings to full alignment, while the growth and inflation momentum values have remained broadly stable in direction. Environments like this have historically coincided with choppier equity behavior, a heavier tone in credit, and intermittent strength in real assets, as markets grappled with both slower growth and ongoing inflation in the data. On the rate side, the 10-year Treasury yield sits near 4.40% with a green momentum label, defined here as the 30-day rate of change trading above the 60th percentile of its 3-year range. In 9 of 11 comparable periods, this coincided with measurable acceleration in the inflation composite within the subsequent 2 weeks. That pattern reflects how, in the sample studied, firm yields at these levels have often shown up alongside strengthening inflation math. Labor conditions are represented by initial jobless claims, which the engine classifies with a green momentum label, again defined as a 30-day rate of change above the 60th percentile of the trailing 3-year range. In 8 of 11 comparable periods, this coincided with decelerating employment growth within roughly 3 weeks. The math is capturing that, historically, rising claims at this pace have tended to line up with softer labor market trends in the data. Credit is reflected through the Treasury curve spread between the 10-year and 2-year yields, T10Y2Y, which carries a red momentum label, defined as the 30-day rate of change below the 40th percentile of its 3-year range. In 6 of 9 comparable periods, this coincided with periods of compressed bank and cyclical equity performance relative to the market within about 1 month. The curve's recent behavior has historically lined up with more cautious credit pricing, even as levels shifted over time. On the equity and commodity side, the energy sector stands out after a gain of about 2.36% against broader equity weakness and a WTI move to roughly $102.25, a configuration that the engine translates into green momentum for key energy benchmarks, again defined as a 30-day rate of change above the 60th percentile of their 3-year range. In 7 of 10 comparable periods, this coincided with elevated volatility in broader indexes within the following 4 weeks as sector performance became more dispersed. These observations describe how the sample behaved under similar conditions, rather than implying that the same path must repeat. Turning to conditional thresholds, the first trigger on the map centers on the 10-year Treasury yield. If the 10-year crosses 4.45% and holds that level for 5 consecutive sessions, the observed behavior in the historical sample has been that inflation composite measures accelerated in 9 of 11 comparable instances. Within the framework, that type of move has often lined up with transitions toward more inflation-intense configurations, such as expansion to acceleration in past data. The second trigger focuses on equity sentiment. If the Fear and Greed Index drops below 15 and holds that reading for 5 consecutive sessions, confirmation scores deteriorated in 7 of 9 comparable instances, often moving from strong to more mixed alignment. In the math, those episodes have tended to coincide with regime watch conditions, where the existing configuration faced a higher incidence of change. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we have been discussing. Second, it runs a fixed four-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all four layers agree on a symbol, Atlas records it as a potential long or potential short condition under the framework. These are time-stamped model readings, logged for members to study as historical signals. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the four layers do. Atlas monitors 407 symbols independently of any regime label, and members study how those symbol-level conditions have behaved across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what, if anything, to do next. All of this is framed as potential, educational in nature rather than prescriptive instruction. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.